Unquestionably, some people have become very rich through the use of borrowed money. However, that's also been a way to get very poor. When leverage works, it magnifies your gains, your spouse thinks you're clever, and your neighbors get envious. But leverage is addictive. Once having profited from its wonders, very few people retreat to more conservative practices. And as we all learned in third grade, any series of positive numbers, however impressive the numbers may be, evaporates when multiplied by a single zero. History tells us that leverage all too often produces zeros, even when it's employed by very smart people. This was a quote given by Warren Buffett back in 2010, a few years after the 2008 financial crisis. Hi, my name is Koukun and I'm a real estate investor and I run a real estate team here in the Niagara region. If you're interested in learning more about what we do, check out our free beginner's guide to investing in the Niagara region. I was comfortable refinancing and having up to 4 times debt to equity in my real estate portfolio. Up to this point in my investing, anytime I had equity in a property, I would refinance and take the money out and buy more rental properties. The reason I was fortunate with the most recent real estate downturn is that I had a very hard time actually refinancing my properties recently. I was working with a bank that was really giving me a lot of pushback because the properties had appreciated too quickly in such a short time period. In under a year, one of my properties went up over $200,000, so they didn't want to allow me to pull it out. That actually saved me quite a bit because I had the mindset back then, if I had equity, I was going to pull it out and I was going to buy more rental properties. And if I had done that up to this point, this past year in 2022, we had a real estate downturn of 30% in our market here in Niagara region. So if I had leveraged up to 4 times the equity in debt and it dropped 30%, I would be underwater. The reason I was comfortable with that debt is, like, in my own experience with real estate investing, I actually started out when I was 18, 19, saving, the little money I was making, and I was able to invest it in real estate, and the initial savings of about $35,000 became over $1 million in equity in under 10 years. So every time I had equity built up, obviously I put that money into real estate that was leveraged 4 times, especially the first and second properties. And the equity that was built, I was able to pull it out and I would buy more property. So that really worked well for me up to this point. What it may have changed is my perspective in terms of the risk that comes with refinancing. I took it for granted that whenever properties have equity, I should refinance, take the money out and buy more rental properties. And I didn't associate any risk that comes with refinancing properties, meaning to increase the mortgage on a property, taking that equity to buy more properties. And right now I own 2 properties with some partners. And these properties, even after the downturn, have a 40% equity position. It was, I think, closer to 60% before the downturn. So a lot of equity. The reason for that, again, we had a tough time refinancing those properties, and we kind of decided as a group that, we're happy with those properties. We don't really want to buy more properties in this partnership, but we're going to keep these properties and ride them out. And, those properties have had a very good cash flow position. Now that has slightly been squeezed. They were on variable rate mortgages, but because we didn't refinance it, even though rates have gone up, the payments are still manageable. This is not the case with some of my other properties that I have refinanced. So here are 3 points I want to make when it comes to managing your real estate debt or leverage and to control how addictive it may be in terms of influencing your investment decisions. The first is limit how many times you're willing to borrow at 80% loan to value to invest in real estate. I think we take it for granted that because you can borrow 80% from a bank to buy a rental property, you should always do that. I think it comes with some risk because when you borrow at 80%, you have 4 times the amount of debt to equity. And if the real estate market drops 20%, as we saw last year, you essentially are in a position where you have no equity in the property. Now, our past 25 years here in the GTA, we've experienced a rising real estate market. So most of us aren't familiar with or worried about a real estate correction. And as we saw last year, it is very possible for reasons that I believe are out of our control and out of our ability to predict. So it may happen out of nowhere. And along those same train of thought, if you do want to grow your portfolio beyond just a few rental properties, consider putting larger down payments, 30-35% down payments. There's nothing wrong with putting more money down if you have it available, because that reduces the debt, it reduces the leverage, and it potentially increases the cash flow you're going to get from the property. And the more cash flow you get, the bigger buffer you have from the leverage affecting your financial situation. Second, be careful about following the herd when making investment decisions. The real estate investing community is really a community, and there's a lot of meetups and people love to discuss ideas, strategies, and learn from each other, which is a very positive thing. One of the negatives from this community, however, is the herd mentality when it comes to real estate investing. Especially recently, the BRRRR strategy over the past few years has become extremely popular. And BRRRR, for those of you who are not familiar, is the buy, renovate, refinance, rent strategy, where you buy a property, renovate it, you build equity through renovating and adding value to the property, and then you want to pull out all the equity in the property to buy more properties. It's a very scalable investing strategy. The downside, which is very clear in this past year, which most people didn't consider, is by refinancing the property to pull all the equity out to buy more properties, you are significantly increasing the debt on that property, and many times it reduces the cash flow. Many of these properties people were using the BRRRR strategy on would end up having little to no cash flow, sometimes even negative cash flow, because they pulled out so much money to further invest. So when things go well, they have this beautiful large portfolio that is increasing in equity more and more and more, and they're able to continue to buy. But if they're fully leveraged, when we had a year like last year, I'm sure there are investors right now that are sitting on portfolios with zero equity. And the nice part about debt in real estate is that very rarely are you going to get a call from a bank and have them tell you need to pay the mortgage off immediately, unlike stock investing. So if you buy stocks on margin, you can be sure that you're going to get margin called if the investment goes down. However, if you're in a tough position right now where you have no equity in the properties, the mortgage payments are going up, for example, if you had variable rate mortgages, you're in a tough position because you either have the option of no cash flow or selling properties at a loss. And that is a very painful position to be in right now. The third point is limit how many times you're willing to lever up your real estate. Investing is a personal decision. It is not just a financial decision where you can, calculate numbers and ratios, especially when it comes to leverage and borrowing money. You don't have to do the same thing that everyone else is doing. Just because every other real estate investor is borrowing as much as they can to buy more properties, that doesn't have to be the path you follow. I've personally come to the place in my investing journey where I want to be very intentional about the total debt I have, and if I'm going to increase it, at what ratio I'm going to keep the equity to the debt, and how much cash flow I want to have from my portfolio. So I would really suggest decide what you want real estate to do in your life. What results do you want from your investing, and then take appropriate risk to meet that goal. When I got started, I had in savings about $25,000, which I partnered up with my brother and we put into our first property. Those, at that time, it took me about a year and a half to save that money. If I lost it, it would really not be a big deal because I was young, I was willing to save again, I was willing to do what it took to get ahead. So at that time, I believe leverage made sense because it allowed me to really make a big stride forward. I've now come to the point in my investing where, between the partnerships and my own properties, I've bought and sold close to 10 real estate properties. I've built up a net worth at one point of over $2 million in equity. That's since come down due to the crash, but it's still over $1 million in equity. And this is the nest egg I want to protect and grow for the long term. And when you have leverage, it reduces your staying power, your ability to hold on to the properties for the long term. And that is how you really build the wealth in real estate. So in conclusion, leverage is addictive. While real estate investing is very tough to do without leverage, be the few that retreat back to conservative practices once you have achieved the results you desire. How has this real estate downturn affected your views on leverage? Let me know in the comments below. And if you're interested in investing in the Niagara region, there's a link in the description below if you'd like to book a complimentary consultation with one of the investment coaches on my real estate team. If you like this video, give us a thumbs up. And if you haven't already, definitely subscribe for more investing content. All the best.